Good afternoon, and thanks for dialing in to today's webinar. Some housekeeping rules before we begin. For today's session, we'll have the management presentation followed by a Q&A session. Please remain muted during the presentation. And to participate in the Q&A session, please use the raise hand function to join the queue, and we will invite you to unmute and join the discussion. Now, US rate has been under the spotlight for quite a while now. A lot of investors have questions about the resilience of US economy, the new norm of working from home, and how do all this impact us as investors. Today, we have the management of United Hampshire REIT with us to talk about the recent results and address all those questions. UH REIT is Asia's first US grocery anchored shopping centers and self-storage REIT. It has a 763 million asset under management. It's anchored by 22 assets across 8 states focused on the East Coast. So without further ado, let me invite the Head of Investor Relations and Sustainability to introduce the management team. Ms. Yulu, please.
Good afternoon. A big thank you to Jialing, Lyndon, and the Maybank Security teams for hosting us today. Thanks all for taking your time today to join us at United Hampshire US REIT Investor Presentation. My name is Wong Siu Lu. I'm the Head of Investor Relations and Sustainability at the REIT Manager. Together with me, we have our management team, including CEO Mr. Gerard Yuan, CFO Ms. Winnie Yap, and Chief Investment Officer Mr. Derek Gardella, joining us from the US. Together with the management team, all of us will be available to address any questions you have during the Q&A section later. In UH REIT's recent 2023 full-year financial results, I'm very pleased to share that our REIT has again delivered strong growth in gross revenue and net property income. UH REIT also recorded an increase in portfolio valuation, supported by the strong operational performance of our resilient asset classes. I understand some of you might not be very familiar with United Hampshire US REIT. Therefore, I'd like to start this presentation with a brief introduction of UH REIT, starting with our sponsor. The REIT is named United Hampshire US REIT after our two strong and reputable sponsors, namely UOB Global Capital and the Hampshire Company in the US, who jointly own the REIT Manager. Both are also our major shareholders and each own approximately 8% of the REIT. UOB Global Capital was founded over 20 years ago, back in 1998. It manages over US $3.7 billion AUM and is a global asset management subsidiary of United Overseas Bank, a household name that we are all very familiar with. The Hampshire Company is a privately held, fully integrated real estate firm with over 60 years of experiences. They own and or operate a diversified portfolio of 180 properties across the US with AUM in excess of US $1.7 billion. Both sponsors have developed a close partnership for nearly 15 years since 2008, where they jointly formed 3 funds with approximately US $1.3 billion of AUM to focus on investing in income-producing real estate in the US. Moving on, UH REIT is Asia's first and only US grocery-anchored shopping center and self-storage REIT. In the other words, we actually owned grocery-anchored shopping center in the US. They are single-story shopping centers located in a suburb. They typically have a supermarket as the anchor tenant with smaller shops next to it. For instance, a DIY shop, health and beauty shop, or a casual restaurant like a pizzeria. Our other asset class is modern climate-controlled self-storage properties. As you can see from the map, we own 22 properties in total. They are all located along the US East Coast, which is very densely populated and it has higher income levels. As we cater to the essential day-to-day needs of our shoppers, UH is uniquely positioned to benefit from the robust, essential, non-discretionary spending of the US consumer. Next page. Since our IPO in 2020, UH has been very successful in executing our portfolio and asset management strategy. The REIT AUM has grown 30.6% since IPO to US $764 million. We have since acquired 3 yield-accretive acquisitions and completed 3 divestments, all at healthy premium above valuation. Our most recent divestment, Big Pine Center, was sold at 8% premium to our purchase price in August 2023. In addition, we completed construction of 3 new properties, namely a supermarket for Publix at Port St. Lucie, Florida, our Perth and Boyd self-storage in New Jersey, and most recently, our new store for academic sports, which also in Florida in November last year. I'm very pleased to share that we have achieved several milestones since IPO. For example, UH is included in the SGX Fast Track program within second year of listing since 2021, due to our excellence in compliance and governance standard. We were honored to receive recognition as the Platinum winner for our annual report at the International Hams Creative Awards 2023. Early last year, we were also awarded the Best CEO, CFO, and Best Retail REIT at the Asia Pacific Best of Breed REITs Award. In addition, in recognition of UH intense investor relations effort, for 2 consecutive years, UH was awarded the Certificate of Excellence in Investor Relations by our magazine Southeast Asia in December last year. Since September 2022, UH has been included in the 3 IH Singapore indices, namely ISG Real Estate Index, IHS REIT Index, and lastly, IHS GE ESG Transparency Index. We hope that our presence in these indices will help us to grow our brand and familiarity and make our name a more commonplace to large institutional investors and funds, and ultimately grow the trading volume and liquidity of our units. With that, I have concluded a brief introduction of United Hampshire US REIT, and I shall now hand it over to our CEO, Mr. Gerard Yuan, to bring you through the key highlights and financials. Over to you, Gerard.
Thank you, Siu Lu. Good afternoon, everyone. Thank you for joining us this afternoon. I wanted to start with a quick update on how the US economy is doing. I'm sure a lot of you have seen in the news, US economy is doing very well. US fourth quarter GDP grew at 3.2%, and the unemployment rate is low. It's a healthy 3.9%. In fact, in today's Business Times, Goldman Sachs just revised the GDP growth for 2024 for the US upwards as well. So they're seeing quite a strong momentum there. Inflation has slowed significantly, down from its peak in mid-2022, and is now down to around 3.2%. Importantly, the personal consumption expenditure, or PCE, which is the metric that the Fed tracks for its 2% inflation target, this was just 2.4% in January. Importantly, for a necessity retail REIT like UH REIT, next slide please, the US consumer, who makes up 2/3 of the US economy, is continuing to spend very strongly. As you can see, retail sales was up 1.5% year-on-year in February, and grocery sales continue to remain stable. It grew 0.2% this month. US consumer confidence also remained relatively strong, although it has eased slightly due to a moderation in views on the business environment and labor markets. If you recall, in December, the US Federal Reserve indicated the possibility of cutting rates this year. So just like the rate hikes that happened since 2022 had a negative impact on S-REITs, falling interest rates could provide a significant uplift for the S-REITs as well. As Siu Lu has shared, our properties are mainly supermarkets located in the suburbs, not in the towns or not in the large cities. So that's why our properties are quite resilient to economic cycles. We have also been a very big beneficiary of the work from home trend because we're located near where people live, and that means that people now not only live near our properties, but they also work near our properties. And that means they have the chance to come and visit our properties not just on weekends, but on weekdays as well. So, not too surprisingly, our 2023 operational performance has been very strong. Here you can see occupancy for our grocery and necessity properties was over 97.97%. We also have one of the longest weighted average lease maturities among the S-REITs of 7.1 years and a very high tenant retention rate of 92% since our IPO. In terms of leasing risk, this is very low. Only 2.2% of our leases mature this year, and only 4% mature in the following year. On the capital management front, we've been very proactive in terms of refinancing our loans well ahead of their maturity. We are pleased to share that just last month, last month, we completed the refinancing of our Arundel mortgage loan, which means that we have no loans due at all until November 2026. That's about 2.5 years from now. So a very long period of time when we have no loans to refinance. In addition, 79% of our loans have been hedged into fixed rates, and over 61% of our income is from essential non-discretionary goods and services. I would also add that the majority of our leases are what we call triple net. This means our tenants pay for their own utility bills and other running costs, and also reimburse us for the common area costs as well. The majority of our leases also have built-in rental escalations and no early termination clauses, which means that over the life of the lease, we're expecting to receive higher rents over the lease period. Overall, as Yulu mentioned, due to the strong operating performance of our properties, we are very pleased that our 31st December annual valuation is almost 5% higher year on year. This obviously is quite different from some of the other REITs. This is despite higher cap rates on average, because our NOI and our occupancy perform very strongly. In terms of NAV, this also remained relatively stable at US 74 cents per unit. In the face of high interest rates, one of the ways we've been able to grow the REIT's DPU organically is through new developments and asset enhancement initiatives at our existing properties. Since our listing, we have completed 3 construction projects. Pleased to share that the latest of these 3 projects that you can see in the picture, this is a 63,000 square feet store for Academy Sports. It was completed ahead of schedule last year and opened in November in time for the peak festive shopping period. Construction took less than a year, and we're already seeing the benefits of the higher NPI and rental revenue. This new store was built on existing land that we own, and our tenant, Academy Sports, is a Fortune 500 company and one of the largest sporting goods retailers in America, and we have a new 15-year lease with them. In addition to the significant additional revenue we'll get from the store, it will also increase the footfall to the property and the overall attractiveness of the property. As we will share with you later on, we are seeing very strong leasing momentum given the favorable supply-demand dynamics in the sector. A recent Cushman & Wakefield report found that strip center vacancy rates are at their lowest ever since Cushman started collating data back in 2007. Asking rents are also at the highest levels in that period. There is a significant undersupply of retail space at good shopping centers. This is due to high construction costs and great demand from retail tenants. We signed a new 47,000 square feet lease with Dick's Sporting Goods at Upland Square. They are taking over the space that was previously leased by Bed Bath & Beyond, and at a much higher rental rate. In Albany, Price Chopper, which is the leading supermarket in the region, bought over the store from the existing tenant ShopRite to replace an older existing store. Price Chopper is planning to invest a significant amount of capital to remodel and relaunch this store under their popular Market 32 brand. So the good news for us is that not only is Price Chopper paying for their own renovations and capital expenditure, but they also signed an extended 6-year lease with us, and this lease will only expire in December of 2038. The strong leasing momentum from the end of last year has also carried on to the first quarter this year. We are very pleased to have signed lease extensions, long-term lease extensions with LA Fitness at 3 locations, which will enhance the stability and WALE of the portfolio. We also executed a 7-year lease extension with Home Depot, and the lease now only expires in 2034. That's about 10 years from now. Moving on to our year-end valuations, which we touched on briefly. As I mentioned, overall valuation, portfolio valuation is up 5%. Yes, capitalization rates in our sector did move up, but they didn't move up as much as many other sectors. And this is obviously due to the higher interest rate environment that we're all facing. However, because of the strong operating performance of our portfolio, which results in higher NOI and lower vacancy rates, we are very pleased that the overall valuation is higher. Now I'll talk about our 2023 financial performance. As you can see, top line has continued to be very strong. Gross revenue is up 7.1% year on year, while net property income is up 7.6%. This strong performance is due to the new leases that we signed, rental escalations from existing leases, the contribution from Upland Square, which we acquired in July 2022, as well as the contribution from the new Academy Sports store that I mentioned earlier. Distributable income was slightly lower than the previous year, largely due to higher interest rates. In second half of 2023, we retained 1.3 million as capital reserve for capex requirements, which includes the Academy Sports building, which cost $12 million to construct. This brings our total retention for the year to $2.8 million. And for fourth quarter, we also elected to receive our management fee in cash, as this minimizes unit holder dilution given the current share price. Excluding these two factors, our adjusted DPU for 2023 would have been 5.54 cents. This is just 5.8% lower than the previous years. And considering how much interest rates have risen, I think this is pretty commendable. In terms of capital management, I mentioned earlier that we proactively refinance all our loans well ahead of the maturity, and that we just completed the refinancing of our Rundle Plaza loan. Now we have no refinancing needs all the way until November 2026. It's almost 3 years, but 2.5 years more from now. Our weighted average debt maturity is quite long at 3 years, and 79% of our loans are hedged to fixed rate. Our interest coverage ratio is slightly higher than the previous quarter at 2.9 times. Looking at our balance sheet, as you can see, our total assets have grown and now exceeds US $800 million, and our NAV remains stable at 74 cents. In terms of total shareholder returns, UH REIT performed very well in 2023. We were featured on the front page of the Business Times as the second best performing S-REIT for the year, providing unit holders a total return of almost 23%. Our DPU yield, this is as at 31st December, is 9.5%, and this is 5.6% higher than the 10-year US Treasury yield. Our price to book ratio of 0.68 times is also quite attractive. And now I'd like to hand over to Derek, our Chief Investment Officer, take you through the detailed portfolio outlook and update.
Thank you, Gerard, and good afternoon, everyone. On the next slide, UH REIT's portfolio continues to achieve high occupancy and strong tenant retention. For the year ended December 2023, UH REIT's grocery necessity portfolio continued to achieve high occupancy with 97% of 97% and a tenant retention rate of over 92%. In 2023, 36 new and renewal leases were completed comprising over 528,000 square feet. These leases comprise tenancies across consumer services, consumer goods, and food and beverage sectors. We'd also like to highlight that over the next 4 years, there is minimal lease expirations across our portfolio. On the next slide, I'd like to just provide some highlights of our self-storage portfolio. Across the self-storage industry, fundamentals continue to normalize, while our assets continue to demonstrate stable occupancies with rents remaining high. Since the IPO, UH REIT has successfully managed to produce meaningful rental rate growth at our 2 properties. And as you can see, our occupancies have remained stable and our rents have been also trending upwards or remaining stable as well. So our properties in the self-storage portfolio continue to do well along with our grocery necessity properties. On the next slide, we always like to share with the investment community the high quality of our tenant base. Our top 10 tenants serve the needs of the U.S. consumers through providing essential goods and services. 90% of our top 10 tenants provide essential uses to the U.S. consumer. We're fortunate that our top 10 tenants comprise cycle-agnostic sectors and include discounters, grocery stores, wholesale clubs, and home improvement stores who deliver a WALE of 8.2 years. Additionally, over 61% of tenants across our entire portfolio are focused on essential products and services benefiting the U.S. consumer. These essential tenants have a WALE of 7.8 years. On the next slide, we always like to highlight the strength of our tenants, and we like to share their sales performance with you. For the fourth quarter, Walmart sales grew 4%, which was driven by strong growth in grocery merchandise sales. E-commerce sales also increased 17%, and that was led by strong pickup and delivery. Comparable sales at Ahold were down by 1%, yet in line with expectations as inflation moderated. Notably, Ahold's Food Lion brand achieved a milestone of 45 consecutive quarters of positive sales growth. Publix recently also released its full year 2023 sales performance, which increased 4.7% over the prior year. Their quarterly performance in the third quarter was 7.2%, following a slight decline of slightly over 4% for the fourth quarter. Yet on a full year basis, Publix sales performance in totality was solid at 4.7% over the prior year. On the next slide, we'd like to provide a highlight of our ESG journey. UH REIT is focused on sustainability, and examples of this include the installation of LED lighting at 59% of the properties in our portfolio and exploring opportunities to install solar across our portfolio as well. UH REIT maintains high standards of corporate governance and has been included in the SGX Fast Track for its good compliance track record. UH REIT is dedicated to enhance engagements with its tenants, communities, and team. Strong volunteerism exceeding 100 hours globally highlight the organization's commitment to the communities in which we serve. And now we'd like to move on to the outlook. In the news media, we have heard about commercial property values, and the media has unfortunately correlated broad commercial real estate values with the office sector. The office sector behaves very differently than strip centers, grocery necessity properties, and the self-storage sector. As you will see, the strip center sector and self-storage sector values experienced a meaningful increase over the past 3 years and behave completely differently than the office sector. UH REIT's real estate sectors continue to perform well and benefit from the demand for essential retailers, close proximity to the consumers' homes, and strong demand from tenants for our retail space at our properties. On the next slide, we always like to talk about key trends within omnichannel retailing. Omnichannel retailing continues to be at the center of a retailer's success by offering the consumer multiple ways to pay for and pick up goods. The physical store serves as a last mile distribution hub as the consumers have multiple options for how they pick up and receive their goods. Retailers are also increasingly looking for different opportunities to optimize the physical store and seek different ways of getting goods from the physical store to the consumer. Examples of this include Walmart launching a drone delivery service in Texas, Starbucks exploring different concepts of how to utilize the physical store, whether just to have only pickup or also have in-store dining and various versions of pickup, either in-store, curbside, or through a drive-through. DoorDash, who offers delivery services, is exploring different ways for select grocers and consumer goods companies to deliver products locally to the consumer as well. On the next slide, we'd like to highlight some key trends within the grocery necessity sector. And the grocery necessity sector continues to demonstrate high levels of occupancy and leasing volumes remain strong. One opportunity for the sector is the limited pipeline of new developments that are scheduled to commence construction in the coming years. So the limited amount of supply of developments that are planned are very small, and the demand for space by tenants remains very strong. The supply of retail properties under development is at the lowest in comparison to other properties, as you can see in the left-hand chart, and the outlook through 2028 demonstrates this trend will continue, where there's limited retail development and there is strong demand for space from tenants. This is largely a factor of the high construction costs and higher interest rates, which are certainly creating strong demand at grocery necessity properties across the sector. Foot traffic also remains strong with an emphasis on essential goods and services. And fitness was the best performing category on a year-over-year basis. On the next page, we'd like to just provide some data points on our self-storage, on the self-storage sector. And across the self-storage sector on a national basis, rental growth continues to normalize. Sector occupancy is forecasted to be flat for 2024, and the pool of potential renters is estimated to be deeper today and larger today due to the rise in users throughout COVID. New construction also remains limited due to the high construction costs and limited development. And now I'll turn the presentation over to Sue Liu, who will share a video.
Thanks, Derek and Gerard, for their detailed presentation. So before we dive into the Q&A section, I'd like to showcase a short 2 minutes video on Garden City Square, one of our grocery necessity retail property in New York State. Yeah, please play the video now.
Welcome to Garden City Square.
Sorry, I think we face a little bit of technical issue here. But no worries, since
Square foot BJ's Wholesale Club and a 55,000 square foot LA Fitness. BJ's Wholesale Club is a Fortune 500 company listed on the New York Stock Exchange. It is a membership-only warehouse club operator with 238 stores in the United States. BJ's Wholesale Club offers significant value and savings on an assortment of groceries and general merchandise to its members. Located next door, LA Fitness is a leading American gym chain with more than 550 clubs across the United States and Canada. As part of its omni-channel offering, in addition to traditional in-person shopping, BJ's Wholesale Club also offers buy online, pickup in store. This provides its customers with greater shopping options and additional convenience. LA Fitness also offers both in-person fitness training and classes, as well as virtual classes under its omni-channel platform. Both properties feature exterior and interior LED lighting, as well as energy-efficient HVAC systems and eco-friendly water fountains. BJ's Wholesale Club has also dedicated significant time and resources to its ESG efforts across its national footprint, including Garden City. Garden City Square benefits from a highly dense population in the surrounding neighborhoods. It is strategically located in a highly trafficked retail corridor just over 45 minutes from Midtown Manhattan via the nearby Meadowbrook Parkway, Northern Parkway, and Interstate 495. Its prime location makes it convenient for shoppers from the New York metro area. With a commitment to sustainability and omni-channel services delivered by nationally recognized tenants in a highly accessible and convenient location, Garden City Square is a valuable piece of United Hampshire U.S. REIT's grocery and necessity-based real estate portfolio.
Sorry for the technical glitch. I hope you enjoyed the video. Till date, there are a total of 6 property videos specially curated for All About UH REIT education series. They are all available on UH REIT website as well as our LinkedIn pages for your viewing and on forwarding to your colleagues or clients. So do remember to follow UH REIT LinkedIn page for our latest update. So with that, I shall now hand the mic back to Jialin to moderate the Q&A section. Jialin, over to you.
Yeah, thank you, Gerard, Derek, and Silo for the presentation. Before we move on to the Q&A session, let me just remind the audience to participate in the Q&A session. Please leave your questions in the chat box, and we will direct your questions to the management. And we have some open questions from the audience, and maybe let's start with them first. The first one is regarding to capital management. So we know you have done some refinancing last year. Could you give us some color on the refinancing? Is there any changes to the margin? And for the debt maturity in November 2026, could you share with us what's your plan for this?
Yeah. Thanks for the question. So we refinanced the majority of our loans in the end of 2022. In fact, it was in December 2022 that we completed the loan. So we're actually very fortunate because we did it early before the as you know, there's been a bit more challenges in the US office sector this year. So I think more banks and lenders are affected. I'm not surprised that margins maybe would have crept up this in 2023, but we completed our loan well before that. So we're very fortunate to get it done. I think the margins we got were very attractive. And it gives us a lot of peace of mind knowing that we don't have any refinancing at all. I think there was a question that asked what we're going to do about the November 2026 loan maturity. Well, we refinanced it 1 year, 3 months ago. We've still got 2 years, 8 months to go before that is due. The short answer is, of course, we will refinance it. I guess the underlying question is, what do we think of the situation at that point of time? Obviously, it's very hard to talk about the market, 2 years, 8 months down the road. But one thing I would say is, our sector historically has been, quite well liked by lenders because of the nature of our properties, the types of leases that we have, and the tenants that we have. Lenders have always been very receptive to lending to us, and that's why we've had no issues refinancing. And touch wood, interest rates are hopefully coming down as well, starting towards the later part of this year. So hopefully we'll be in a more benign interest rate environment as well. But I can't give you too detailed an answer about something that's going to happen, 2 years, 8 months down the road.
Yeah. Thanks, Gerard. Then maybe another general question on sponsor support with some of your US REIT peers like Corey, Prime, and Manulife. And just a general scenario, in a case that if the REIT face any difficulties, how will your sponsor UOB and Hampshire going to help the REIT?
Thanks. I think very interesting question. Maybe I'll sort of answer it in two parts. Excuse me. I think the first part is there a need for sponsor support? I think what we've seen, it's quite unfortunate, but there have been certain REITs that have been more affected, office REITs basically, and some of the REITs in China, I think those have had issues, and one in Indonesia. So we are in a very different position. I think as you've seen from our presentation, our occupancy is very high. Our performance has been very strong. We have long WALE, no refinancing requirements, and we've actually been a net beneficiary of the work from home because, as you see, our properties are located in the suburbs. It's near where people live. So actually, we're seeing great demand, great operational performance at our properties. So the the need for sponsor support in our case is that there's no obvious need for any sort of support. Now, having said that, if the question is, how has UOB and Hampshire been supporting us since our IPO? I would say they've been great sponsors, right? They are the largest shareholders of the REIT, but they also own the REIT manager, and we wouldn't have been able to get the IPO done without them, and we wouldn't have been able to complete the acquisitions, divestments, and the new construction buildings without them as well. So I would say they're great sponsors. They've always been very, very supportive, and I don't see any reason why that would change.
Okay, got it. Then maybe since you touch on how street centers and grocery properties have stand out from the other retail, commercial, office properties, then maybe the next question will be with the original onset of the COVID-19 pandemic, we have seen a surging from work from home arrangements, which have benefited UH suburban retail assets. As time passes, do you believe we could see the trend fade and potentially result in a headwind for UH performance?
Derek, maybe I'll let you.
Sure, I'd be happy to answer that. So in terms of the fundamental drivers of how a shopping center is used, both for essential goods and goods and services, essentially. And with that, they're well located in close proximity to people's homes. And what's interesting is developing a shopping center is not particularly easy because it's on many acres of land and it's open air, large car parks, single story. So there has been very limited retail development in the U.S. Over the last several years. And as I mentioned, going forward, there's also viewed to be very limited retail development. So we don't see potentially demand waning. I mean, we serve the essential goods and our properties serve the essential goods and services of the U.S. consumer. And the shopping center itself has also turned into a distribution hub for goods. So if a consumer is going to order online, the goods may be shipped to their home out of the physical store. Also, through omni-channel retailing, the physical store has also enabled the consumer to buy online and pick up in store, do their shopping at the store, or even return their goods at the store. So over the last 3 years, the actual usage of a shopping center has changed from simply going to pick up your merchandise or shopping wise to being this last mile distribution hub. And so, which the uses of a shopping center are also continuing to evolve, where developers are looking to put pad sites or other restaurants in the middle of their the large open car parks and things along those lines. So we are, excited about the opportunities that are presented by the sector going into the future.
Okay, thanks, Derek. And since Derek, you're on the line talking about the general industrial trends, do you mind, let's continue on the discussion and with regard to your self-storage properties, given the recent performance normalization, what is the management outlook on this asset class? Are you guys keen to continue exploring this sector further?
Sure, I can address that. So let's just talk about our two self-storage properties. We're very pleased with the performance. Occupancies remain stable, and we have had our rent growth has trended upwards over the last 3 years. So we do believe it's an important component of our portfolio. One of the interesting, as we look more broadly going forward at the self-storage sector, it is a sector that generally trades at cap rates that are lower than retail. So certainly, that's something we always have to keep in mind in terms of if we were to explore it, given the normalization. And also its location. Location is while location is critical for all real estate, self-storage demand is really going to be a function of the number of individuals living in a given area, as well as the amount of self-storage that's already in the given area. So we are, very pleased with the performance of our two properties. Then that is a result of their locational the various locational aspects and demographic trends. We certainly are always looking at the sector, but we'll see how it continues to evolve.
Okay, thanks for the insight, Derek. And maybe since you have brought up your portfolio, then maybe another question from our audience is with the divestment of Big Pine Center, have you identified any suitable acquisition opportunities? And will you continue to retain a certain percentage of distributable income moving forward?
There are a lot of acquisition opportunities. I mean, the US is a very big market, and the types of properties we look at are, the values between 20 million to 80 million. So, it's not large. And there are a lot of interesting opportunities that we see. One reason we are not executing now is, our gearing is still just about 41%. So we wouldn't want to go any higher by borrowing for new acquisitions. So I think while we continue to look at acquisitions, we're not going to do acquisition that necessarily moves the gearing any higher. But certainly, going forward, I think if there are opportunities to divest some of our properties at good prices and then recycle that capital into better yielding or more attractive properties, these are some of the ideas that we will be looking at, in terms of our active management of the portfolio. There was also a question about, do we continue to retain a certain percentage of distributable income? So yeah, I mean, this year we elected to retain 2.8 million. That's because we had a very large building for Academy Sports that we featured earlier. So that building cost 12 million. We've retained 2.8 million this year. We just felt that with interest costs so high and with our gearing at 41%, it didn't make sense to borrow more money to fund so it was better to retain a bit of income to pay for some of this capital expenditure. Going forward, I really would say it's kind of based on our requirements from period to period. If our gearing is lower or if we don't have as much capital requirements coming forward, I think we would relook at the amount that we retain at each individual period and sort of announce it accordingly. So no firm decision, but I think the approach we take is we'd rather be conservative. I'd rather retain a little bit of income and keep our gearing down to pay for our capital expenditure. But don't forget as well, by building that new building, we're going to have a significant uplift in the rental revenue from that building as well. So it is a positive trade-off when we talk about retention.
Okay, thanks, Gerard. Yeah, looking forward to this completion of this building. And since we touched on distributable income, I think a few questions were centered on your DPU. So will you be able to maintain the 4.79 cents DPU? And, if without stabilization of DPU, investors will be a little bit doubtful as to how, what's the level of the ceiling of your DPU level. Yeah, could you maybe just give a bit comment on this, and also maybe from a historical point of view, how what's your comments on the DPU trend since IPO? Yeah.
Sure. So for those of us who've been with us through IPO, you remember we IPO'd the day before COVID was announced as a pandemic. So during this period of time, we've actually gone through quite unprecedented global macroeconomic challenges, right? We had the whole COVID and all the lockdowns and associated issues with the supply chain. We went through the Ukraine war, which is still going on, which resulted, in sort of interest rates going up to really high levels because of the inflation rate going up. And this year we've had the situation in the Middle East as well added to it as well. So we've gone through unprecedented global macro issues, which has resulted in sharp rise in interest rates, which affects all the REITs. So I think the rise in interest rates has been the main issue or the main cause of the DPU, and it affects all the REITs, right? I think you wouldn't find a single REIT that, as anybody who has borrowings, will be impacted by high interest rates. What I would say is that if you look at our operational metrics, our occupancy is doing well. Our self-storage rental rates are going up, as Derek mentioned. We have a very long WALE. We have very high tenant retention rate. We have no loans due for refinancing anymore because we refinanced it as well. So operationally, I think we're very sound. Interest rates, I think we're all very hopeful that even if it doesn't come down tomorrow or this week when the Fed does its next interest rate announcement, I think there is a strong view that it will start coming down. And if anything, it's near the top of its cycle already. So optimistic from that perspective. And obviously, if interest rates come down, all of us will benefit from the higher DPU for all the REITs. But in the meantime, we focus on operations and growing the REIT. And the Academy Sports building that we mentioned, that's going to be a significant positive contribution to revenue as well.
Okay, thanks, Gerard. Then maybe the following question will be on your DRP. Do you have any plans to do, continue your DRP in the future, especially in the near future, as well as in terms of your funding source? What is the target gearing level that the management is comfortable with? Do you intend to, bring it down a little bit, or, are you comfortable at this level? Yeah.
Thanks. I'll start with the DRP. So this is the dividend reinvestment plan for those of you who are not so familiar. This one basically means that as a shareholder, you have the right to either take all your dividends in cash, so no change, or you can actually take your dividends in the form of units. And the reason why it's beneficial is because you don't have to pay any transaction or brokerage fees. From the REIT's perspective, it's beneficial because we retain some cash, so it improves our capital flexibility and retains some of the cash instead. Ever since we announced the DRP back in 2022, I think we've always offered it for all our distributions. I won't comment on future distributions, but I think generally speaking, we do want to sort of maintain a regular DRP program so that unit holders who are sort of loyal and are happy to reinvest in the REIT, always have the opportunity to come in. I think the second question was on gearing ratio. The reality is S-REITs have got relatively low gearing if you look at them versus private real estate owners and so on. I mean, our own mortgage rates are much higher than 40%, right? 60, 70%. But that's the environment that REITs work in. I look at my peer groups, and I think most of them, and I think what investors like, is a gearing that's just slightly below 40%. Because you don't want to be too low gearing as well, because equity is generally more expensive than debt. So if you have too little debt, you may not have an efficient capital structure. So we're at 41%. We went above 40%, not because our valuations dropped, which is what happened for many REITs, we went above 41% because when we bought Upland Square in 2022, there was a mortgage loan, a fixed rate mortgage loan of 3.6%. And as you can tell, at 3.6%, you're paying less than the floating rate. So we obviously decided to keep that mortgage loan. And by bringing that mortgage loan on board, our gearing went above 40%. So while we're very comfortable where we are at 41%, especially with our latest valuations being higher, I think given our peer groups are in the high 30s and investors tend to like that range, I would say aspirationally, that's the kind of a ballpark that we'd be looking at. But we are very comfortable where we are at this point of time as well.
Okay, thanks, Jared. Then maybe just touching on a continued discussion on your funding. Do you mind sharing your lender as well as your refinancing banking partners?
Could you repeat the first part? I heard the one about refinancing banking partner, but the first part of the
Yeah,
question.
do you mind sharing a bit more on your banking partners? Is it your sponsor bank?
Sure. I saw a question. Is UOB our lender? They were at IPO. They are not our existing lenders now. The very simple reason is when we went out to refinance the loan, we got the some of the banks in the US and North America, they gave us such a competitive rate that we went with their proposal instead. So I think UOB is very supportive of us, but we actually got such a good rate from the US lenders, which is why I can say to you that I think the banks in the US really like our sector, the triple net lease structure, the long lease terms, the very day-to-day non-discretionary nature of our tenants. We got very attractive rates from the North American banks. The two lead arrangers, one of them is CIBC, which is one of the top banks in Canada, and the other is M&T, which is another leading US bank, the US domestic bank as well.
Okay. Thanks for taking that question. And maybe just circling back to your portfolio, we know that we are expecting this rental uplift from Academy Sports opening, but so it seems that the construction was completed last year. So do we already see its contribution to your top line last year? And what will the uplift be after this AEI? Yeah.
Sure. So in terms of last year, I think we had about 1 month because it sort of opened in mid to late November. So we've had about 1 month of contribution. And obviously for this year, we will have the full 12 months as well. I can't disclose the exact uplift because it's just one tenant, so I can't disclose their rental rate or their rental that they pay us. But what I would say is our Port St. Lucie property where this is located, the valuers use a cap rate of around 7%. So I think that's a good ballpark way to look at it. So we spent 12 million to develop the building, and if you apply a 7% cap rate, that kind of gives you a ballpark sense of what kind of contribution we would expect.
Okay. Thanks for sharing the insight. And maybe let's just continue on the circle back to the discussion of self-storage properties. Given the lower cap rate, what's the significance of holding on to this asset class, in your opinion?
I think the self-storage sector is one that we like. It is it also caters to a very fundamental need in the US. It's a very big country. People move around, and they use self-storage very regularly. Certainly, and because we have the right to, the rental rates are not fixed for long term. They're actually something that you can reset upwards as your occupancy goes up and the demand goes up. It's shown good growth as well. So it's a sector that we do like. I would love to buy more self-storage properties, but the cap rates are a bit low now, so the DPU accretion wouldn't be compelling at this point of time. But it is a very nice addition to our portfolio because it provides a lot of potential growth as well. As you can see, the net rental rates have been trending up last year. So it gives an element of growth and diversity to the portfolio of grocery and necessity. Having said that, it's not going to become the major portion of our portfolio, but it's a very good addition to the overall portfolio.
Okay, okay. Thanks for the comment. Then maybe we are running short of time. So Gerard, could you give us a final remark to wrap up today's session?
Sure. Thanks, Lo. Actually, I apologize we didn't get to go through all the questions, but you do have our IR email, so welcome to reach out to us that way. And I do appreciate all the questions because I think that shows a strong level of interest in the sector. And I think for good reason, right? I think for us, for those of us who, all of us do our day-to-day grocery shopping, right? No matter what, during COVID, non-COVID, you still need to buy your bread and your day-to-day. So it's a very simple business and type of property to understand. I think, we've shown over this period of time, the operational performance of the assets has been very strong. And I think it is, yes, it's been unfortunate that there have been challenges from outside the sector. So basically, interest rates moving up across the board for everyone has affected everyone. And in the US, there is some concerns about the US office sector, but and that's been a bit of a spillover effect to all the US REITs. But I think for investors who are willing to take the effort and try to understand the different dynamics, I think hopefully we provide a compelling opportunity for them. Because I think we are very different from office, and office has got its challenges, which hopefully they will overcome soon. But our sector is very different. So for those of you who have taken the time to understand us, I hope you come away from this understanding it better and being able to make a decision about whether you believe in our story as well.
Okay, yeah, thanks, Gerard. And with that, I think we are at the end of today's session. Again, thank you very much, Gerard, Derek, and Siu Lu. It was a pleasure hearing from your presentation, and thanks for taking our questions. And we would like to request for the audience to fill in the feedback form, and we look forward to seeing you at our next event. Thank you, everyone.
Thank you, everyone.
Thank you.
Thank you.
Thanks for taking your time. Yep.
Thank you.
Bye.
Recording stopped.